Hello, everyone. I'm Joanne Lilly, CEDA's Program Director. Welcome to our live stream today, Analysing Australia and China, which is part of CEDA's Global Matters live stream series. Before we start, I'd like to acknowledge that today and every day we meet on Aboriginal land. I'm here in Melbourne on the lands of the Wurundjeri Woiwurrung people. Wherever you're joining us from today, CEDA pays our respects to elders past, present and emerging. We believe in economic inclusion of all Australians, specifically including Aboriginal and Torres Strait Islander people, and we are committed to recognition and to reconciliation. Now, a little housekeeping before we start today. We have a wonderful event lined up for you today with some really preeminent speakers. And as at all CEDA events, we encourage your curiosity and your interaction with our speakers. So to do that, you'll need access to Pigeonhole, which is our Q&A portal, and it's available via the link showing on your screen, or you can enter ceda.pigeonhole.at into your preferred web browser. The passcode for this session is AusChina, that's AUS China, all one word, all caps. You can post your own questions and you can upvote questions put in by other people. So we also encourage you to join the conversation on social media. Feel free to post and use the hashtag, which is AusChina, and please tag CEDA, CEDA at CEDA_news. Now, turning our attention to today's discussion. At CEDA, our purpose is to improve the lives of all Australians by enabling a dynamic economy and a vibrant society. One of the ways we do that is by convening conversations around the issues shaping our nation. You can check out all our future events on the website. But for today, I think you'll agree that the economic dynamics between Australia and China, our largest trading partner, our largest source of international tertiary students, and the ancestral home of around 5.5% of Australians in 2023, certainly have the power to shape Australia's society and economy. So let's turn it over to the experts. Please join me in offering a warm welcome to Professor Jane Golley, who will facilitate the discussion today and will introduce you to our other expert speakers. Jane is a professor at the Crawford School of Public Policy at ANU and all-round Australia-China expert. We couldn't be in better hands today. Thanks, Jane. Over to you.
Thank you, Joanne and CEDA, for the opportunity to share the screen today with two formidable Chinese economy experts. Marina Zhang, Associate Professor with the Australia-China Relations Institute at UTS in Sydney, and Dinny McMahon, Director of Markets Research at Trivium China, a research firm based in Chicago, where it's still only yesterday. So thanks for joining us. For today's hour-long session, which I fear is going to go much too quickly, I'll provide some brief opening remarks before asking Dinny and Marina to speak for about 5 minutes each, and then turning to Q&A. I've got millions, but I'm hoping you will too. We have a rather large task ahead of us to analyse China's economic trajectory and its impact on the Australian economy in the coming 1 to 2 years, while also examining the bilateral relationship and various geopolitical tensions. Just a reminder, as Joanne's mentioned, that the link and passcode details will or should appear on the live stream window or below it on your screens. We're unlikely to get through all audience questions. So to ensure that we ask the ones that are of the widest interest, could you please try and vote for your preferred ones, and we will try and get to those. It is a challenging time to talk about what China's economic trajectory means for the Australian economy when there's so much uncertainty surrounding what it will look like for China itself. With the zero COVID era now firmly in the past, China's GDP is projected to grow at around 5% this year, just as it did last year. Now, some people in the media, I think, present this as a catastrophic slowdown that is only the beginning of a serious downward trend towards economic crisis or collapse. I call these people the collapsists. At the other end of the spectrum are those who are more positive about what the future holds, although I think it's fair to say that virtually no one is as positive as they were 5 years ago or even 2 years ago. And I'd go further than that and say that in my own 30 years of studying the Chinese economy, I've never been so uncertain about what the future holds, while also being less confident than ever before that all will be well. So yes, GDP growth is reasonably strong. 5% is nothing to sneeze at for any country, even if here in Australia we've become hooked on expecting more from China. But consumer confidence is weak. Enterprises aren't investing amid declining profitability. The stock markets are wobbly. Youth unemployment is high. And fears remain that Evergrande's collapse will spill over into a full-blown property market crisis, as some have been predicting for well over 3 years now. Adding to this the regular news of the ageing population crisis, it's hard to reconcile all of these facts with the 5% growth forecast for this year. And yet that's what we're trying to do while linking it back to what it means for Australia as well. So with that, I'll turn to Dinny to give 5 minutes of his opening remarks focusing on the property sector. Thanks, Dinny.
Thanks, Jane. Yeah, well, as you noted, I mean, so often when we're looking at the property sector or thinking about the property sector in China, those thoughts and that discussion is so mired in the minutiae of whatever the latest news is. I mean, most recently, a court in Hong Kong, decided that it would liquidate Evergrande. But in terms of trying to understand what's really going on in China's property market and the implications, you kind of really need to step back a little bit and kind of look at the bigger picture. So one statistic that people have been using for years now is that up until a few years ago, something like, the property sector generated something like 30% of economic activity in China, which is, broadly true, but that figure doesn't often get interrogated. I mean, why was it so high? And it was so high because China's property market, its housing market, looked very different from really that of any housing market anywhere else in the world. Up until 2019, 2020, something like all property sales, of all housing sales in any given year, about 90% of it was of newly constructed housing. Now, I don't know what the statistics are for Australia, but I know in the United States, it's a particularly good year if it's more than 20%. In the United States, in most developed markets, most of the housing that gets sold in any given year is housing that already exists. It's the existing housing stock. In China, 90% of what was being sold in any year had just finished, had been built, had recently been constructed. Now, that dynamic is not going to continue. The sheer volume of new housing that China needs is falling, and it will never again return to that sort of elevated level that we saw at the peak in 2019 and 2020. And there's a few reasons for that. Partly it's demographic, because China's population is not only shrinking, but it's also aging. And so that part of the population which wants to buy housing is starting to, is shrinking. And so there's just not as much demand from that as there once was. Now, so often internal migration is kind of held up as the solution. I mean, the percentage of China's population which is currently living in cities is only about 68%, I think. China's authorities often hold up maybe 80 or 85% as a long-term goal, which is kind of in line with sort of developed countries. But ultimately, when it comes to the housing market, that internal migration population, those rural migrants, they can't afford commercial housing. They can't afford all this new housing that has been, that developers have been building for the last 20 years. It's kind of, that is a completely different market, and not one that targets the sort of the millions of people who have been moving from the countryside to the cities. The other thing to keep in mind as well is that one thing that has been inflating demand for newly constructed housing over the last 10, 15 years has been people buying investment properties. Now, we don't know the degree to which, to the percentage of homes owned in Australia, in China, pardon me, which are being held as investment properties. It's not something that the government keeps statistics on. There's been various independent surveys which put the number maybe between 12 to 22%. Either way, it's a very significant proportion of the population of the housing stock is being held as an investment property. Now, in most other parts of the world, an investment property then gets rented out. So it feeds through into the supply of housing. China, it works very different. it's generally assumed that most of those investment properties are being held empty. So people don't recognize the return on those properties from rental income. They recognize the return in terms of capital gains, or the expectation of capital gains, that if they just hold this property long enough, one day they'll sell it off in the future, and that's where they'll get their return from. Now, the problem with that is kind of what I was just saying about, demographics, that, as long as there was this sort of expectation that there were more people coming through that would have a demand for new housing, that it kind of made sense to be able to buy a property and hold it empty. But that is not going to be the case in the future. And in fact, something that we've seen over the past year is that the volume of people who are selling their investment properties, the volume of houses that are being bought and sold from the existing stock rather than newly constructed housing, that's starting to increase. And so the whole dynamic of the market is starting to change. So you've kind of got these structural problems that are undermining demand for newly constructed housing, which has been the driver of economic growth for years. But there's also another factor that's sort of undermining demand as well, and it's equally important. And that is the funding model of China's property developers. And what I mean by that is that developers are incredibly dependent on pre-sales. That is, that they sell the units, the apartments that they are buying prior to completion. Usually they sell something between 18 months to 2 years prior to the completion of the unit. They sell it in its entirety. It's not a question of the buyer just putting down 20%. They buy it in its entirety. And this has kind of been central to the funding model of China's developers. And so this is the problem we're in at the moment, is that you've got a whole lot of unfinished developments around China, in which a percentage of the apartments have been sold, and the developers need to sell the remaining in order to be able to raise sufficient funds to be able to finish construction. But in this environment, people aren't willing to buy unfinished housing as much as they once used to. I mean, it used to make a lot of sense in an environment where property prices were always going up to buy now prior to completion rather than 2 years' time, because who knew what the price would be in 2 years? So it made sense in a market where the prices were always rising to buy homes prior to completion. That dynamic does not exist anymore. And so you kind of have this, in addition to that as well, people aren't willing to buy uncompleted housing because they're not sure whether the developer that's building it is actually going to be around in 2 years' time or even 18 months' time, just given the stresses of the system. And so the thing to kind of watch in 2024 is, I think the central government is increasingly aware that it doesn't have the ability to kind of create housing demand out of whole cloth anymore. In the past, that's something it's been quite confident about, ramping up demand, cooling it down when it wants to. But now it's pretty clear that it's lost all control out of being able to stimulate demand for new housing. So what we're going to see in 2024 is, sure, there'll be efforts to, in that direction, but the authorities are trying to create construction demand unrelated to commercial housing. What they're going to be doing is trying to promote something more like what we see in Singapore, with a kind of a two-track housing model of commercial housing and then affordable housing. Because, as I said before, all these migrant workers who've moved to the cities who can't afford commercial housing, they live in pretty substandard housing conditions. So the goal is to increasingly start building more affordable housing for China's population. That's maybe something we can talk about a little bit more later on. But ultimately, trying to create a new source of construction activity is incredibly important, because such a big part of the private sector, a whole lot of employment, a whole lot of small firms are involved in housing and involved in construction. So creating a new source of construction activity is something that's going to be essential, just to kind of, create more economic activity this year. Now, of course, this is not going to be a silver bullet. China's problems go well beyond the property sector these days, in terms of household expectations being weak, the business sector's expectations being weak, but at least it is, a potential bright spot in a kind of a key part of the economy for the year ahead. Anyway, back to you, Jane.
Thanks, Dinny. Obviously, lots to talk about there. The property sector is so useful for getting a sense of the structural problems and the imbalances that both the Chinese government and the people are grappling with. I think inequality is one that is going to play out in all sorts of different directions, and we're seeing it there in housing, as you talk about, the difference between those rich urban investors and then the poor rural people who can't possibly afford the housing that exists. That's probably a good lead-in, Marina, to your opening remarks. And you're going to talk a little bit about China's current growth paradox, which I think taps into quite a lot of those issues going beyond the property sector. Over to you, Marina. Thanks.
Thank you, James. Thank you for CEDA to invite me. So before we discuss any impacts of Chinese economic growth on Australian or China's decline in economics on Australian, I would like to share my observations on what's going on in China. So I use this term growth paradox to describe what's happening in China. So there are contradictions or inconsistencies between economic statistics, namely the GDP growth last year over 5.2%, and the collective confidence and collective sentiments shown in China's market and in business and among the population. So let's just have a quick look of some of these contradictions. And as A shares indicated last year, and the total value evaporated over 70%. And that's something like, that's something like the total cost investment China would put into Belt and Road initiatives over its lifetime. And in the first couple of weeks, another 7 trillion disappeared. So this indicates a collective sentiment or a lack of confidence of China's growth from not just the institutional investors and the normal investors. And I would like to share several points to explain why such a consistency coexist in China. First is, unequal benefits distribution among the large, especially state-owned enterprises and urban elites, as Danny and Jen have already mentioned, and with the rural residents and SMEs, small and medium enterprises. So I talk a bit about SMEs. The reason SMEs is so important in understanding China's economic growth is, I'm actually a scholar and studying innovation. So from innovation studies perspective, China's SMEs have been the backbone of Chinese manufacturing sector that sustains China's status as the world factory. So the China's supply chains backed by SMEs actually have been built to supply the global market. And look what's happening during the past couple of years since the onset of a trade war between the US and China, and followed by COVID and increasing reshifting of supply chains away from China. So this cascade effect on China's SMEs have been more than what we have expected. And SMEs actually facing a very uneven, unfair time in China all the time. I mean, given the Chinese internal political restrictions, and you can see a lot of large investment projects and military or defense projects cannot be given to SMEs. So therefore, the state-owned enterprises actually have been the middleman, being the agents. They taking, they subcontract a lot of work to the SMEs, and they make agent fees. But one question I just very curious to ask is, during good times, SMEs and Chinese SMEs and supply chains have been built on this very large overcapacity. So you name it, in every niche segments, they're overcapacity. There are many internal competitors. So this kind of overcapacity, during good times, they can provide both flexibility and efficiency in supply chains, even dealing with crises like pandemic. But a big but is here. When the global economy is going down, the impact in the domino effect is impacting largely on SMEs. So therefore, we can see SMEs over several quarters, the PMI that is an indicator to measure the confidence level of services and manufacturing sectors globally, have been in contract zones. So that means SMEs are struggling. And another thing I want to mention is, just let me look at my notes. And all these things actually cannot be just isolated into the domestic factors in China alone. So China's economy has been part of the global economy for quite some time, 20 years. I mean, we talk about the golden age of globalization between 1998 to 2018, and now deglobalization and de-risking from China have been the major theme in all Western media. So what China needs to do is, well, China really needs to adjust its foreign policies and to make the position in the global supply chains to be better, because this increasing sense of building an self-reliance ecosystem in China and building an internal circulation in China is not going to work, because SMEs employ 80% of Chinese people, and they rely on the open market, global market, to make a living. So if we cannot solve these problems in the geopolitical sense, or China's economy is facing even bigger challenges ahead. I think that's what I can talk about, and I give back to Jen, and we can discuss further on the impact on Australian.
Thanks, Marina. I know there's lots more that you can talk about. I've got the first question actually come in from the audience, and it was also related to my first question. Back to you, Dinny. On the property market, the question from the audience is about will the switch to constructing affordable housing just kick the can down the road, given the underlying structural problems? But I wonder if I could ask you to also reflect on what it all means for Australian commodities demand as well.
So in terms of kicking the can down the road, I don't think it is. There is a genuine demand for good quality, affordable housing. So you kind of look at China's 300 million, internal migrants who move from the countryside to the cities. Typically they've kind of been left out of sort of the housing construction revolution that China's had over the last 25 years. And so there's a real demand for good quality accommodation, because they can't afford. The thing is, not only can they not afford to buy the commercial housing that's being constructed, but they can't afford to rent there either, which is one of the reasons why people tend to buy investment properties and not rent them out, and instead hold them empty. So the way that the government sees it is that there's a real potential here to do something like with what exists in Singapore, where there is both a kind of a free commercial housing market, where, I mean, when foreigners move to Singapore, that's what they're allowed to buy into. And then there is a housing market which is constructed, small scale housing, which is constructed by the government. It is affordable rents. There is a path to buying, but then once you've bought that, you can't then sell it in a free public market. There's also all sorts of restrictions. So there is a real need for this sort of housing. It has been neglected for a very long time. To give you an idea of where people typically live when they can't get normal, commercial housing, you have a phenomenon called urban villages in China's big cities. And so these are areas which once upon a time were villages in the countryside, and then they were sort of swallowed up by cities that were expanding. But because the land ownership rules were a little bit different, these villages continued to be villages. The original owners kind of lived there, and then they added a second level, and then maybe they added a third and a fourth. And so it was cheap, poorly built, often very cramped accommodation. And this is where the urban migrants ended up moving to. So, that's kind of what the government is now looking to replace by tearing down, replacing with affordable housing. So in terms of construction activity and in terms of demand for resources, this is no substitute for the traditional commercial housing market. And there's two reasons for it. One, because the size of the units are going to be significantly smaller. So if I think commercial housing traditionally was a minimum of 70 square meters, I might be a little bit wrong, but a lot of this affordable rental housing is usually in the range of about 40 square meters, 45 square meters. So the sheer scale is smaller to start with. And secondly, at the moment, the government's only talking about doing this in 30 cities, 30 very large cities. But there has been talk of increasing that to, I think, 50 or 70. But the point is, I mean, it can only really be done in places where there is a significant migrant population, and ideally a rising migrant population. And that's not necessarily the rule for everywhere in China. So rather than being sort of the great hope to replace commercial housing, it is not an exercise in kicking the can down the road. There is real housing demand, involved in this, in this plan, but it's not a substitute for the commercial housing market, just in terms of the scale and where the housing is actually going to be built. So what it is ideally it is an additional source of incremental construction, which in a perfect world might start to put a floor underneath the sort of the collapse in housing investment that we've seen over the last few years.
Thanks, Dinny. Look, I'm going to follow on with that. I can see questions coming in on the Australia relationship, and I promise we'll get to them. But Dinny, you've written a fantastic book. I am going to give it a plug. He hasn't asked me to do this. It was called China's Great Wall of Debt, Shadow Banks, Ghost Cities, Massive Loans, and the End of the Chinese Miracle. And I just highly recommend it, written in 2018, but still so relevant and so readable. But on that note, so you know a lot about local government debt in China, and it does seem to be one of the other big structural problems facing the economy. Can you tell us a little bit about Beijing's approach to dealing with that local government debt and the connection, well, back to the property market and back to Australia, two of the big sectors that provide our energy resources leads into the country are, of course, construction and then local government investment in infrastructure.
So there's two ways of looking at this particular question. One is, to what extent, what are the authorities doing to try and deal with this huge debt problem? And secondly, given the extent of the huge debt problem, can we expect local governments to continue building infrastructure at the pace that we've grown accustomed to? And in terms of the second one, the government investment in infrastructure and public works is essential to maintaining Chinese economic growth at its current levels, particularly given weaknesses in other parts of the economy. It is the one part of the economy where the government can exert real control over. And so we've seen over the last few years that regardless of weaknesses in other parts of the economy, infrastructure investment broadly based on, there's different ways of measuring it, but it's kind of been growing still annually at about 9%, which is quite it's significant given that the economy is growing at about 5%. So the question is, can that continue given local government debt levels? And I think the really interesting thing we've started to see is that traditionally the central government has regarded infrastructure investment as primarily, not exclusively, but primarily being the responsibility of local governments. And with good reason, right? So much infrastructure is local. The economic benefits are experienced by the local businesses, the local community, the local government. So why should this be something that the central government should feel obliged to fund? Now, that is starting to change. At the end of the last year, we saw something very interesting. The central government issued 1 trillion RMBs worth of sovereign government bonds, the funds of which were then distributed to local governments so that they could spend on things like disaster relief and prevention works. So, working on a big focus on water conservation projects and things like that. But ultimately, it was money for infrastructure at a local level being provided by the central government. Now, this was a huge change because typically Beijing's been reluctant to do that. But I think that potentially is the way of the future, partly because this year, 12 provinces have been told that they cannot increase their debt levels, and they have been explicitly told that there's a whole range of infrastructure that they cannot spend money on. And we're talking about the 12 most heavily indebted provinces in China, like places like, Tianjin, Liaoning, the three northeastern provinces, Yunnan province, Inner Mongolia. Their debt levels are so heavy that the central government is not willing to allow them to take on additional debt. And if they are going to spend money on infrastructure, it has to be things that Beijing regards as being essential, like affordable rental housing. Now, what seems to be happening is that they can borrow less, but that 1 trillion renminbi in disaster relief, that's going disproportionately to those 12 provinces that can't borrow as much anymore. So I think we're starting to see what the way of the future might be. Central government realizes that the economy can't afford for the pace of infrastructure investment to slow down. But it also recognizes that certain provinces are no longer in a position to sort of maintain the rage in terms of their pace of investment. So the central government is starting to take on a greater share of that burden. I think that how it does that will probably change over the next couple of years, but I think we're finally starting to see that transition. And of course, to bring it back full circle, I mean, this is incredibly important to Australia, because given the weakness in the housing market, the last thing we want to see is sort of for there to be a drop-off in infrastructure investment as well. And I don't think that's going to happen. I think we're going to see the pace continue at a fairly aggressive clip.
Thanks, Dinny. The questions are pouring in now. I'm going to try and kind of weave them together, and I think I'll go back to Marina with this one first. It's about China appearing to have been remarkably, having great social stability in past years, and the questions about the anti-corruption crackdown and what that means. But can I link that into consumer and investor confidence? If any of you read Adam Posen's Foreign Affairs article at the end of last year on China's economic long COVID, his bottom line was essentially that the Chinese government is failing to boost confidence because the authoritarian turn has just made it impossible for them to do so. They've lost the trust of the people, essentially, and that's playing out in the consumer and investor sphere. Has that got anything to do with the anti-corruption crackdown, Marina, or are there bigger issues at play there on what's keeping that confidence down at present?
It's related, I would say. Anti-corruption campaigns have been going on for quite some times, and the consequences, direct or indirect consequences, are that local governments, they are constrained in their policy making and in their implementations. And local governments in China have always been operating like entrepreneurs. They participate in local investment, local economic activities, and they're competing peer-to-peer. But now the sense of local government officials, sort of, if you do nothing, is less likely you make any mistakes. Otherwise, you make mistakes in any of those economic activities. So people basically, using this internet slang, 躺平, lying flat, is, you do nothing. And this feeling extends to not just government officials, and also SME and entrepreneurs and the local people. So this is really like cancerous cells growing in the economy. So this, of course, passed on to consumers' consumptions and investment confidence of the small and medium enterprises. So that's my interpretation.
And I'm just going to stick with one more question on the internal developments. There's a question here about China relaxing its household registration system, and what are the implications of that for the Chinese economy, or perhaps for the property sector itself, Dinny? And just to follow on from that one, a quick question, perhaps maybe complicated, but is the property tax a solution for local government debt?
Well, this is a very big question. I mean, it's perhaps related to this so-called very big chess game the central government is planning. So that is, to define from a kind of top-down approach, which city should take functions of politics, which should be the finance center, and so on. So the government is relaxing its residential registration schemes is largely related to the housing market. And of course, because even the large cities in Shanghai, Hangzhou, Beijing is perhaps slightly different, and Shenzhen, the real estate markets, my observations are all declining, not rapidly, but gradually. So the government obviously hopes, especially local governments, hoping that if we open the restrictions for those people who want to come to the big cities, well, that might boost the local real estate market. But on the other hand, with a lack of confidence in the future earning powers and employment and upward mobility, just to think about it, people are very reluctant even to rush to those big cities. I was in China in January, and I just could see, well, first of all, a very curious absence of foreign faces, even in big cities in Beijing and Shenzhen. And even the cities are quite empty. In this month, during the Chinese New Year, things perhaps are slightly different. But in January, the situation was pretty empty.
Dinny, did
And
you want to
Jane,
add
if I can
anything
say
there?
something about the property tax. Firstly, it's at the moment, there are 2 cities in China that have a trial of property taxes. This goes back to 2013. That's Shanghai and Chongqing. This year, Chongqing has actually been gradually dismantled over the past year, pardon me. Chongqing has actually been gradually dismantling aspects of its property tax. Now, the way I see it, it is not the solution at all. I think in some ways it would be quite terrifying if China imposed a property tax. And the reason is, if you imposed a property tax, particularly on people who have investment properties, because investment properties in China don't generate rental income, they're sitting there empty, that means that they don't generate any income until they get sold and they generate a capital gains. So if all of a sudden you're requiring people to pay tax on a property that they are holding empty, you're asking them to pay tax on an asset that isn't generating an income, which means that they have 2 options. Either 1, they can start renting it out, or 2, they can sell it. Now, for the reasons I was talking about before, rental isn't really an option. Yes, there is a huge percentage of the population who needs better quality accommodation, but they cannot afford the rents in the cities in which they live for quality commercial housing. And so renting isn't really an option. So the risk is that if China imposed a widespread housing tax, it wouldn't fix local government problems. What it would do is result in potentially overnight a massive release of investment properties for sale onto the property market overnight. And that would further suppress housing prices and further undermine the demand for newly constructed housing. So that would, for all sorts of other reasons, wreak havoc with local government finances because they generate a lot of tax revenue from construction activities. And so I think that is the risk at the moment. A housing market, a property tax would have all sorts of impacts. It would have a huge impact on the release of investment properties onto the market, and that would wreak havoc in all sorts of different ways.
Thanks, Dinny. Look, I'm going to shift tack a little bit. There's one question here about whether technology or the high-tech sectors have the potential to ultimately supersede property as a key sector for China, which of course starts to draw us into the broader geopolitical relationship and what's happening in the US. The question asks whether that represents any opportunities for Australia, which is, again, another very big press question. Marina, can I turn to you on that high-tech sector? But a related one that's getting lots of votes is about the green energy transitions. And, whether we're talking about renewables or what happens in the coal sector, of course, also very important for Australia. And there's a lot happening in both of those areas. Are they some of the sectors that are going to keep the Chinese economy buoyant in the years ahead? First up, and what might that mean for Australia? Take your pick on the sectors if it's too much to cover both.
Sure. This is a very important question. 2 technological sectors are at the center of geopolitical landscape. The first one is semiconductors and AI. Those are generally general purpose technologies. That means they have very low adaptation cost, but diffusion requires a lot of complementary assets, infrastructures, and takes a lot of time. The other one is related to green energy transition. So that is specific purpose technologies. And as we perhaps all familiar with, China dominates across the entire value chain of green energy transitions, from the upstream mining extractions to processing, smelting, and to downstream applications. So this is the thing related to Australian is really the green technology, green energy transition. Let's just have a look of the lithium market last year. Last year, the lithium chemicals, so that is lithium carbonates and lithium hydroxide, the price has dropped over 20 to 30%. And who's making money? Australian, the Australian lithium mines, which supplies over 50% of the global lithium markets. But Chinese chemical lithium plants, which investing in equipment, labor, plants, and so on, making those lithium battery-grade lithium chemicals actually are not making money. Not so many are making money. So you look at the distribution of value across the value chain, you know which side is making money. So there is a price regime change in the lithium market. I won't go through the details in there. So I think for Australian to catch up on these kind of specific or invest in these specific purpose technologies in green energy transition actually is not making economic sense. Australians' advantage, as we know, is in research and especially university type of research. So Australian is strong in AI, in quantum computing, cloud computing, but Australia's market and the labor market, it's just not enough to develop downstream markets. So for Australian to develop, to catch up, to make a position in the global technological market, the best way is to maintain its collaborative attitude with both the US and China. So in a sense, to plug into this global value chain of technological innovation, that's the best way Australians should do. And that's the best way for solving Australians' so-called innovation capability problems.
Marina, as a follow-up, do you think that the Australian government is going to heed your advice? I'm sure most people listening here know that the Albanese government, late last year announced $2 billion worth of financing to solidify Australia's position as a world-leading provider in critical minerals, of course, lithium being one of them. And you've basically argued that, sure, we need to advance our investments with geopolitically aligned countries, but if we leave Chinese companies out of that, we're going to stunt the sector. Do you think they're going to listen to you?
I don't know
because obviously that then really affects how Australian investors and plot their own strategies in the future as well.
Well, I don't know whether they will listen to me, but it's my obligation to share my research and to the public. So on that front, if I come back to the SME overcapacity in China, and the SMEs are not just about manufacturing, it's also about construction and mining. So especially in the mining industry, and the one thing I would say is because the value chain, supply chain is very, very long. So any shock from either supply side or the demand side travels across the wavelengths. It takes time. So people from different markets, from different ends, actually can feel it in different ways. So for Australian, and geopolitical reasons, it's very safe, it's very essential for Australia to build up its so-called, nice to have capabilities. But from innovation efficiency perspective, as I said, China has built these long supply chains, and at each niche segment, there are overcapacity. There are a lot of capacities over there, with extensive costs, not just financial costs, but also environmental costs. For the specific technology sector as green energy transition, and the utmost goal for humans actually is to reduce carbon emissions. And if we're competing on building extensive capacities in processing, smelting critical minerals. What's the benefit?
Well,
So yeah, that's my argument. Yeah.
And on the high tech side, there are many more sort of national security arguments that can be lent on, but when it comes to the renewable sector, it's very hard to find national interest grounds in which we shouldn't be cooperating with the Chinese. So I think we can expect to see a bifurcation of the industries in which we continue or advance our cooperation with them and those in which we don't. I'm going to come back to another question. So both about China, and I'll go to Dinny on this one. It's back to housing. Does China see some of the same intergenerational wealth challenges that Australia and other economies are facing, but particularly when it comes to housing? I think you touched on that in your opening remarks, Dinny.
Yeah, I mean, I think the big issue is that you've got an aging and a shrinking population. So a lot of wealth. I mean, a huge amount of China's household wealth is tied up in housing, more so than perhaps any other large economy. The stock markets haven't been a significant sort of place where households have absorbed, invested their savings. Neither is the bond market. So I think something like between 60 and 70% of household wealth has traditionally gone into China's property market. Now, of course, as sort of China's population of retirees gets bigger and bigger, then a couple of issues sort of come up. One, do people sell their apartments? Their investment apartments, do they hold on to them and try and hand them on to their kids? Does it make sense trying to hand it on to their kids given what's happening with the population? So there's a whole lot of questions, but I don't think it kind of China's housing affordability issues are very different from those in Australia. Certainly, its housing affordability has been a debate in China for years, but not so much at the moment because prices have been falling for the last couple of years. If anything, the real issue in China at the moment is because prices have fallen so much. I mean, it's difficult to know exactly how given the nature of China's markets, it's kind of difficult to put your finger on just how much any given home has fallen in value. But I think the real issue here is that prior to, say, COVID, people could fairly expect that their home would double in value, more than double in value over the coming decade. Now, when so much of their household wealth and their savings and their retirement nest egg is sort of wrapped up in housing, having the confidence to know that that is going to double in value over the next decade affects everybody's consumption decisions. It affects how much you need to save. It affects whether you can go on an international travel holiday this year. It affects what type of school you can send your kids to. Now, regardless of how much housing prices have fallen at the moment, I think the real wealth effect in China at the moment is that people, firstly, no longer expect the value of their home to double in a decade. The real issue is they're not sure if it's even going to rise at all over the next decade. And so the impact of those expectations are really sort of starting to change some fundamental things about the Chinese economy. It certainly affects hugely people's optimism about their future. It affects their willingness to consume. And it's really not clear at all how that's going to change in the immediate future. So yeah, there are certainly issues in terms of generational wealth, household wealth, expectations, just people's willingness to consume and what it means for retirees. But China's going through a fairly unique set of problems that are kind of quite different from what Australia's experienced.
Now, look, with just 10 minutes to go, I'll turn to the Australia-China relationship. There are two questions here. One is what the three of us, I think, see as the key risks for the Australian economy based on the China outlook. And our first question was about whether we believe Australia has genuinely improved its relationship with China in the last few years. So for the sake of being provocative, I might say I think the language has improved. The diplomacy has certainly improved and there's been a softening of tone. But substantively, I think the Australian government continues to signal a fairly clear choice, and that is aligning with the United States and its allies and other like-minded countries on a whole range of issues. And I'll go further than that and say, whilst also continuing to encourage engagement with China where we can, I actually see that as the biggest potential risk to the Australian economy in the next few years, particularly with, of course, a big election coming up in the United States. Whichever way that goes, the pressure is on us to diversify away from China. The Chinese government and the people know that. And I think we are running a serious risk of being left out of the opportunities that will come with China's green energy developments and with its high-tech developments as well. But I'm happy to stand corrected by either of the other two panelists if you'd like to make a comment on either of those points.
I may add a bit of my observations. My feeling is this is not just in Australia and or in China, and maybe it's in every society. I mean, you cannot just use a unified tone to describe the feelings, especially towards another country. So this is especially true for Australian-China relations. I can see in China, in Australian, people are pro to bilateral relations, and the people are opposed to these kind of connections. So is very difficult to say, okay, the diplomat relations are improving, but in some corners in both societies, people are opposing a kind of or a pro or supporting to the Australian-China relations. So I totally agree with what you said. I just to say, there are different voices in both societies.
Dinny, anything to add on that one? Perspective
No, I'd
from
actually
America?
just echo what Marina was saying, because I think as much as anything, it's not just what Australia does and what Australia does and doesn't do. It's also as much how China sees the world. And I think China, particularly given the way that the world responded, or sort of Western nations, US allies responded to Russia's invasion of Ukraine, I think China sees the sort of the potential to be locked out of key markets as a genuinely potential systemic threat at some point in the future. So, I mean, you just kind of look at China's iron ore policy, for example. It doesn't like the fact that it is incredibly dependent on Australia and to a lesser degree, Brazil. And that's been the case for years. And it's been trying in many different ways to try and, reduce its dependence. I mean, it is throwing a lot of resources at trying to find new iron ore deposits domestically in China. It's throwing a whole lot of resources at trying to recycle steel domestically in China, and it's encouraging Chinese companies to develop their own iron ore mines overseas, like specifically in Africa. I think that would be going on regardless of any sort of change in the Australian position or sort of incremental improvements in the relationship, because I think that at the end of the day, China is kind of sees strategic vulnerabilities in its own economy, and it's kind of working to sort of to kind of address those. Of course, something like iron ore, regardless of what they're doing, it's never going to be able to plug the gap, plug an Australian-sized hole. But at least that kind of gives you an indication of kind of the mindset and how they're sort of moving from the Chinese side.
And a really good example of how we need to understand China from within and think about the ways that they're reacting to changes rather than just, viewing it all through our own lens. Look, just 6 minutes to go now. I wonder if I could ask you first, Dinny, to give us one key takeaway point, and then to you straight away, Marina.
I think the thing to keep in mind over the next couple of years is that so often when we talk about China's economic challenges, whether it be population or debt or whatever, it's so easy to kind of draw a straight line from where we are at the moment and kind of extrapolate. I mean, given the debt problems, given what's happening in the property sector, given the slow pace at which they're dealing with non-performing loans and recapitalizing the banks, given this, given that, then it is inevitable that we will end up in this point at a given point in the next 5 years. if we've learned nothing from the last 20 years, it is that Chinese policymakers are incredibly creative when it comes to dealing with their own policy problems. China has a very unique political economy. No other country's economy operates in the same way as that of China does. And yet so often we have economists from overseas saying, look, this is what China's problem is, and this is what they need to fix it. What usually happens is that China comes up with its own ways of dealing with its own problems. And its problems are quite acute at the moment. And what we should be expecting over the next couple of years is creative solutions, both on a micro level and big picture level, to dealing with those problems. Now, it doesn't mean those solutions will be successful, but we should keep in mind that we shouldn't be just extrapolating that whatever problems they're facing are going to get worse from here to the horizon. Beijing has agency. It will do whatever it can to address it, and it will address those problems in ways that we do not necessarily anticipate today. Anyway, that's what I'd say the takeaway is for the next couple of years.
Marina?
Well, I mean, from China's perspective, I think China's growth in the future is not going to be continued investment in big projects, infrastructures, for example. Rather, China needs to focus on investing or increasing its spending on public education, public healthcare, aged care, to release people's fears about their uncertain future. So this is called inclusive growth strategy. And the second one, I think globally, China needs to improve its diplomatic positions globally, especially in its relationship with the United States. But of course, this is entirely related, entirely up to the US, not really to China, not entirely, but partly. So because China depends on a open global market. And third, in terms of technological sharing collaboration, I think it's essential to differentiate different technologies. For green energy transition, this is the issue that is related, that is about our essential future. We should learn how to collaborate. And critical minerals are actually not scarce in their reserves. They're scarce because nations are competing to stockpile them. That makes them scarce. So we need to learn how to share them and how to even share the technologies, how to processing them, how to applying them, because those are very important for our future.
Well, I like that collaborative, positive finish. And I think my key takeaway for today is, and it's not really what investors want to hear, but it's to expect the unexpected, because uncertainty really is going to be the dominant theme, I think, for the Chinese economy in 2024. So you won't hear me, and I don't think either of the other two speakers basically predicting that there won't be a crisis, because by definition, a crisis is essentially unpredictable, apart from in demography, where we can predict it pretty clearly and know that it's not likely to be a problem. What I would do is still encourage everyone to read beyond the headlines about the Chinese economy and to question the dominant narratives that seem to take over, because I think, as you've learned, I hope today, things are almost always certainly more complex than that. On that note, with a minute to go, I'd like to thank Marina, Zhang and Dinny for their time and insights today. And thank you all for tuning in and raising so many questions. I hope we managed to answer a good chunk of them. You will receive an email, a post-event email with a link to the recording of today's discussion if you'd like to go back and listen to any of it. It will also be available on CEDA's website in about 1 week. Please do stay in touch with upcoming discussions via ceda.com.au, where you can also register for CEDA's upcoming events. And 2 of these include the Economic and Policy Outlook on Thursday, the 22nd of February in Melbourne and via Livestream, and also the ACCC Policy Update on Thursday, the 27th of March. That's in Sydney and via Livestream. Thank you all once again, and have a fabulous Friday.